Somebody who's been saying that a reality check is coming for some time now is Ashwini Agarwal. He's our guest now on the program, founder and partner at Demeter Advisors. Ashwini, good morning. Good to have you with us here. Thank you for your time. And, this is portfolios now comfortably, I think, across the board should be between 25 to 35%. I mean, if you were in more riskier stuff, very high P stuff, you'd be down more. But everyone is down, varying degrees now. What's the sense, Ashwini? Where are we and what do you see ahead, near term?
So, morning, Prashant. Thank you for having me here. All of us knew this was coming, right? We just didn't know when, and we just didn't know why. The point that Surabhi was making earlier on the show is that these things were trading at three-figure digit PE numbers, and those kind of PEs are never sustainable. Very rarely have those kind of PEs survived, to deliver stellar returns, over a longer period of time. So I think this is the reckoning that the market is going through. Obviously, the investor sentiment is now short. So anything that doesn't have a modicum of value is being sold off. I think that cleanup will continue for a while. The dispersion in the small cap stocks across the valuation scale is very, very large. So, you have stuff trading at half times price to book among some of the financials, and then you have companies trading at 100 PE on the other hand. So my sense is that not all is lost. Even if you go back and think about what happened between 2018 to 2020, and I dare say that this is not as bad as what we went through back then. You had stocks, you had ideas that delivered you reasonable returns if you knew where to look. So I think that's what's going to happen ahead. I think we should expect flatlining of the frontline indices, maybe some more downside in mid and small. But I think there will be rich pickings if one were to be willing to look deeper.
Ashwini, hi. Thank you so much for being with us this morning. It's always difficult to buy because when the serious money is made when you buy when there is enough pessimism, when there is no clarity about the future. It's very easy to buy when there's clarity. Then you only have to worry about valuations and nothing else. But this is a time when valuations may be in your favor, but narratives, numbers, none of that seems to be adding up. So in this environment, what are you looking at? Where would you deploy money?
So, interesting question, Surabhi. I hinted at financials. Okay, I'm looking at some of the financials which are trading well below book or at book, where businesses are well run. I don't see the outlook for financials to be as challenging as it was back in 2018. I don't see any macroeconomic imbalances. I don't see, there's some stress in credit quality on the unsecured borrower side, especially individuals, but outside of that, there is really no stress. So, that's one area I'm looking at. I'm still looking at chemicals where business cycle has been very negative from an earnings perspective last 2 to 3 years, overstocking, high raw material prices, et cetera, et cetera. A lot of that has washed through the system. So that's again looking quite interesting to me. I think frontliners, there are some places where I can see some value. That's also looking interesting to me. And there are other manufacturing companies, bottom-up ideas that look good. And as you say, it's hard to buy when, the tape is so red. And the only thing that I do in times like this is say that, if I have 100 rupees of cash, I'm going to deploy it over the next 3 months. So you buy every day, you buy a little bit, and then you buy a little bit lower, and that's how it goes. We'll see how that plays out.
You said financials. Ashwini, yes. If you could be a little more specific than that, because it's such a large, umbrella, capital markets, yeah. Insurance, lenders, non-lenders, all of that, BFSI, large banks. What now? So
again, some of the small banks, some of the life insurance companies among the frontliners, some of the, even microfinance. Some of the microfinance companies are now trading below book. These business models have survived. These are very well capitalized balance sheets backed by strong promoters. It's just a cycle. The way I think about microfinance is that when you make a 10% spread, that spread provides for a poor cycle every 3 to 4 years, and that's what you're going through. And, I don't see these businesses blowing up, unless, of course, there's some regulatory intervention. I mean, we saw this unfortunate comment from a political leader saying that there should be a cap on rates. I mean, I think that shouldn't happen for the simple reason that these companies bring credit to those who have no access to credit from elsewhere. And if you don't allow a risk spread to emerge, this business will not be there, and those borrowers will be forced to go to local money lenders. I mean, show me NBFCs or microfinance companies that over a cycle have made a 25% ROE. Nobody has. So where is the question of excessive spread? I mean, these are well-run businesses. They're not overly leveraged, and they have strong promoters. So I think there might be an opportunity here. It's going to be painful. You can't call the bottom, but I think over a 3-year time frame, there's an opportunity.
All right, Ashwini, the real pain today is in the EMS space. Keynes,
Yes.
That stock is down close on 17%. If I'm not mistaken, you have been cautioning as well that party is getting too exciting. Be closer to the door, otherwise you're going to be stuck out there. What do you think? I mean, Keynes has pulled back 40-45% in a matter of, I think, less than 20 sessions. Your view on this space?
Nigel, when I was a young man and I had entered the market 30 odd years ago, there used to be a company called Samtel Color, screwdriver technology. They would buy the color tubes, they would put a TV together, and we all thought that it was a great business. It wasn't. I mean, I think the EMS companies are good businesses. I'm not comparing them to Samtel in the sense that they'll go bust. But I think that they are good businesses only to the point of, an assembly operation. It's a very simple operation. It requires scale, so that requires a certain management skill. But beyond that, what is it? I mean, and why should I pay 100 times PE or 150 times PE? I mean, I don't quite get it. So, I think, yes, if you ask me to buy these stocks at 30, 35, 40 times PE when they're growing at 50, 70%, it makes sense. But at 100 times PE, it doesn't make sense. So, you're paying for the next 3 years of growth, and you have no idea what's in store 3 years down the line. So, I continue to stay away.
Yeah. Absolutely, and I think that's exactly the dilemma that the market is dealing with now with the EMS stocks. Keynes being the latest example. Ashwini, little short on time because of all the earnings today, but thank you very much. We look forward to a longer conversation next time you're with us. Have a great day.